Welcome, everybody, to Multifamily Report, market news and industry updates. This is a new series that we're launching for you, the multifamily investor, to keep you up to speed on what's happening in the markets, what's happening in the news, and how does that relate to multifamily as an investment class. I'm your host, Travis Watts, and in today's episode, I have pulled a recent article here released in the month of September from wealthmanagement.com. This is a group that I sometimes do webinars and educational content with. And the name of this article is Construction Costs Bite into Apartment Investment Returns. So I'll highlight just a few snippets from this article. I'll share them with you, and then I will share my thoughts on how this pertains to multifamily as an investment class. So the first thing in this article that they mention is rising labor and material costs coupled with more expensive debt due to rising interest rates are combining to cut into yields on multifamily development projects. They go on to say that the cost of construction will probably keep rising, cutting into the yield of investments in apartment developments, even though a few materials, such as lumber and concrete, have become less expensive in the last few months. A quote from Ken Simonson, the chief economist for the Associated General Contractors of America, says, developers have been getting hit on two sides, the financing side and the bid side. The cost of construction materials are still rising, but not as quickly. In fact, the PPI, which is the Producer Price Index for inputs to multifamily construction, grew 8.4% over the 12 months that ended in July 2022. The cost of labor also continues to rise relentlessly. Skilled construction workers are still hard to find, and now salaried staff positions are also difficult to fill, says Simonson. Nearly all, in fact, 93% of construction firms report that they have openings for craft laborers, and of those firms, nearly all, 91% effectively, say that they have trouble filling those positions, according to AGC's annual workforce survey. And last but not least, in conclusion, the shortage of workers lead to both high cost and delays, putting even more stress on developer bottom lines. So it's a great article and a great topic and conversation. What's my take on this? I would say the first thing is this article is about real estate development in the multifamily sector, which differs greatly from pre-existing multifamily housing, which is what we focus on here at Ashcroft Capital. What development does not have going for it when compared to pre-existing multifamily is they don't have renters in place today and the ability to push rents both with inflation and through a value add business plan. So yes, all real estate is being affected, but it's not all created equal. Let's look at a couple examples of that and I'll elaborate. We'll start with single family homes. So with single family homes, the primary driver to how much someone's willing to pay matters in terms of interest rates and what kind of loan they can get from the bank and comparable sales in your local area. So if you own a home and both homes on either side of you or in your neighborhood are taking price cuts, or you're seeing foreclosures or short sales, there's effectively nothing you can do about it, but just take the hit on your potential sale price if you chose to sell your property. New development, as stated in this article, is actually taking a hit on two fronts: the financing cost, which is due to the rising interest rate environment that we're in, and on the bid side, which is how much a potential buyer is willing to pay for the property once it's completed, because now they have higher interest rates to factor in. Value add multifamily, or pre-existing already occupied multifamily housing, is what we focus on here. And make no mistake, it's still being affected by rising rates. However, we are purchasing properties that already have below market rents in place today. And by doing very mild construction, which includes renovating units and landscaping and amenities and clubhouse, we're often able to justify raising the rents back to the market level because, after all, we've created a better community for the residents. For existing multifamily apartments, the primary valuation is based off the net operating income. So when rates rise, yes, it hurts your potential sale price because the next buyer coming in has a higher interest rate to factor in when purchasing your property, which effectively takes their cash flow down, so they have less net operating income. But if we're effectively executing our business plans and we're able to raise rents in the process of holding an asset, then we are now increasing the net operating income as we go along. And that is helping to stabilize the pricing of these assets. In addition to just simply raising rents, there's a lot of things that we consider when we purchase a property. And a few of those examples would be win-wins between the residents and the investors, where we can truly add value to people, but also add value to the property and hopefully be able to sell in the future at a higher price than what we purchased for. And a few of those include fencing in ground level yards for added privacy for our residents or for residents who have pets. Adding covered car parking for residents, or what we sometimes call premium parking, for those residents who want to get their vehicles out of the weather and out of the elements. Adding secured package locker systems on site for the residents has added security. It cuts down on theft, and it's usually 24/7. So when Amazon or UPS or the post office comes to deliver a package, they can go right to this package locker system. The residents get either a text or an email when they get a package delivered, so they know exactly when it's there. And then they get a little code to come up to the box, type it in, boom, and a door opens, and there's your package. So it's much more convenient for everyone. Adding washers and dryers inside the units, if they don't have them already, is a huge value for both the resident and for the property itself. So our residents don't have to go walking in the rain or elements across the entire property to a laundromat and sit around waiting on their clothes to be done. They can do it right from the convenience of where they live. There's numerous types of profit sharing that we do on our properties. It's kind of property specific, but for example, if we have home security systems that are already in the units upon takeover, then what happens is we have this contract with the security service. The resident pays a monthly fee to them, say $25, and we are sharing in a portion of that $25 for having their service on our property. Another one would be with cable TV, internet, Wi-Fi, these kinds of things. Again, the resident pays a normal market rate for that service, but we are getting a percentage of that profit by using those vendors exclusively on our properties. As for common areas that require electricity or water, such as the clubhouse on a facility or hallways or parking lot lighting, we switch out lights often to LED to help save money on the electric bill. Might put in new types of plumbing or more efficient toilets and sinks and faucets and stuff like that to help cut down the overhead and cost. So all of this is helping drive the net operating income in addition to lifting rents. So there's many other ways that we add value here at Ashcroft Capital. That's just to name a few. So zooming out, going back to this article that we're talking about in the topic of today, I would say it's this. Rising interest rates is generally not a great thing for real estate, but not all real estate is created equal. So it depends on the particular sector within real estate that we're talking about. So hope you guys found some value in this short video. Thank you for watching. If you want to take a deeper dive or have any additional questions, you can reach out to myself, Travis Watts. I'm the Director of Investor Education. You can reach me at travis@ashcroftcapital.com. Thank you so much for watching. Stay tuned for the next episode.